Welcome to The Explainer. Buying a house, it can feel like you're trying to navigate a giant maze, right? Well, today we're going to be your guide. We're going to decode the whole world of real estate financing from where the money actually comes from all the way to that final signature.
So, let's just jump right in with the biggest question of them all. Think about it. How does a bank just hand over hundreds of thousands of dollars for a house? It can feel a little bit like magic, but trust me, there's a system behind it. And once you understand that system, you're already on your way to mastering it.
Okay, here's our game plan. We'll start with the mortgage marketplace, then we'll walk through the path to your loan. After that, we'll look at choosing your tools, the different kinds of loans, and we'll wrap up with the rules of the road that keep you safe.
All right, first up, the mortgage marketplace. Let's figure out where the money actually comes from. Before you even think about applying, it really helps to know what kind of world you're stepping into, Who are the big players here?
So this is super interesting. The mortgage world is basically split into two parts. You've got the primary market. That's the part you see and interact with. It's where you go to the bank, you meet the loan officer, you fill out the application. But then there's this whole other world working behind the scenes. That's the secondary market. And this is where the real action happens. Your lender actually takes your loan and sells it to investors. Why? Because that's how they free up their cash to go lend money to the next person in line. It's the engine that keeps the whole system moving.
So let's drill down on that primary market for a second. The easiest way to think about it? It's the retail storefront. It's the bank on the corner, the credit union, the online mortgage company. Basically, any place where you, the borrower, meet the lender to actually create the loan. This is your starting line.
And that brings us to why the secondary market is so important. You've probably heard names like Fannie Mae and Freddie Mac, right? Well, they aren't lending money directly to you. What they do is buy the mortgage from your lender. And by constantly buying up these loans, they pump a steady stream of cash back to the banks. This is what we call liquidity, and honestly, it's the fuel that keeps the entire home buying machine chugging along for all of us.
Okay, so we've got the big picture. Now let's get practical. Let's walk through the actual step-by-step path every loan takes. Believe it or not, pretty much every single mortgage in the country follows these same 6 steps. It all starts with origination, that's just fancy talk for creating the loan. Then it moves to processing, where all your paperwork gets organized. Step 3 is underwriting. We'll talk more about that in a sec, because it's a big one. Then you've got closing, funding, and finally servicing, which is what happens for the next 30 years.
Okay, let's talk about underwriting, because this is the moment of truth. An underwriter is a real person whose entire job is to look at your application and decide if you're a good risk for the lender. They do a super deep dive into everything: your credit, your income, your job history, and even the value of the house you want to buy. They're the gatekeepers, the ones who give the final yes or no. And then, after all the papers are signed and the money's been sent, your loan enters its final and longest stage, servicing. This is the company you'll be sending your monthly payment to for years and years. They handle everything from collecting payments to managing your taxes and insurance through escrow. And by the way, this explains why you might get your loan from Bank A, but a month later you get a letter saying, hey, start sending your checks to Company B. That's because servicing is a huge business all on its own.
All right, next up, choosing your tools. And honestly, this is probably the single biggest decision you're going to make in this whole process, picking the right kind of loan for you. When you get right down to it, the choice is all about a fundamental trade-off. On one hand, you've got predictability. A fixed-rate mortgage means your main payment is locked in and never, ever changes. On the other hand, you've got potential savings with an adjustable-rate mortgage, or ARM, where you start with a lower rate that can go up or down later. So the question is, what do you value more, stability or potential savings?
There's a reason the fixed-rate mortgage is the most popular type of home loan in the U.S. By a long shot. It's all about peace of mind. Your payment for principal and interest is set in stone for the entire life of the loan. Budgeting becomes super easy. If you're someone who doesn't like surprises and you plan on staying in your home for a long time, this is almost always the way to go.
But hold on, an ARM isn't something to just dismiss. It can actually be a really smart, strategic move for some people. The reason the initial rate is lower is because you're agreeing to share some of the future risk with the lender. What does that mean for you? Well, it could mean a lower monthly payment right out of the gate, which might help you qualify for a bigger loan. It's especially useful if you think you might sell the house in, say, 5 or 7 years before that rate has a chance to adjust. Now, if you're going to consider an ARM, you absolutely have to know these 3 key terms. First is the index. Think of it as a benchmark interest rate that goes up and down with the market. Then you have the margin. That's a fixed number the lender adds on top of the index. So,
Index plus margin equals your interest rate. Simple, right? And finally, and maybe most importantly, you have caps. These are your safety net. They put a limit on how high your interest rate can ever go.
Okay, last section, the rules of the road. And this is so important because you're not out there navigating this all by yourself. There's a whole system of laws and regulations designed to protect you and make sure you're treated fairly.
And these protections didn't just appear overnight. They've been built up over decades. It really kicked off in a big way back in 1968 with the Truth in Lending Act. That's what forces lenders to be crystal clear about the costs. Then in '77, the Community Reinvestment Act came along to fight a nasty practice called redlining. And of course, after the 2008 financial crisis, we got the Dodd-Frank Act, which created a brand new watchdog, the CFPB. So, what's the bottom line for you? What do these rules actually do? Well, they guarantee you get clear disclosures about your loan. They make it illegal for lenders to discriminate against you. They require the people you're dealing with to be licensed and registered. And they created a powerful agency, the Consumer Financial Protection Bureau, to hold everybody accountable and enforce all these rules.
And this quote from the Dodd-Frank Act really gets to the heart of it. The whole point is to protect consumers from abusive financial services practices. It's all about making sure you, the home buyer, are on a much more level playing field with the lenders.
So there you have it. We've looked at the marketplace, walked through the process, checked out the tools, and reviewed the rules of the road. Look, the mortgage maze can still feel a little intimidating, I get it, but hopefully it's not a total mystery anymore. You now have the map, so the only real question is, where will your journey begin?